Hello students, welcome back to yet another video on Vanita Vishram Innovation and Research Center. As always, we are going to discuss a very interesting topic of accounting. But before that, let me introduce myself. Myself, Dr. Himanshu Thhakar. I am Assistant Professor in Vanita Vishram Women's College of Commerce in the subject of accountancy. So let us continue with our discussion as we do in our lectures for various accounting topics. Today I am going to discuss a topic of ratio analysis, and this topic is basically in TY syllabus of VNSU semester 5. So why we are studying this topic in third year, or what is the crux of this topic? Let us first discuss that and then move with the topic. So ratio analysis is basically a tool of management accounting. Now the question arises, what do we mean by management accounting? See, generally what happens is, for any business, financial accounting is the basic thing that is expected to be done to maintain the books of accounts and to know the financial performance for the year. But just by having the results of financial performance is not enough. If you want to improve, if you want to get ahead, you need to compare, you need to analyze, and so management accounting comes into picture. It tries to analyze the performance which is done for the business throughout the year, and then it tries to apply certain tools to measure whether we are going in the right direction or whether there are certain efforts needed to go in a right direction. So one of such tool is ratio analysis. Now, ratio is basically something that every kid must have learned in the school in the subject of maths. So basically, ratio is a tool of comparison. By getting ratios, that is the common figure, you can compare. Let me give an example. If there are two students, one studying in CBSE board and another studying in Gujarat board. Now, when they get the result of 10th standard, you cannot just compare the percentage that they have scored, because the kind of paper they must have appeared or the kind of subject they had may differ. So you need common ground to compare, and you want to compare, when you want to compare your past performance or when you want to compare your present performance with the other companies, then you need ratio as a tool. Now, why we need ratio? First, we need to understand why there is a need of comparison, why there is a need of finding ratios and then comparing. Let us take an example. Now, in this slide, you can see our Mother Earth, where we live, right? It is so big. It has so many countries. It has so many oceans. It has so many people in it, right? But if you look at it in absolute terms, you will feel it's very big. But then comes the comparison part. If you compare it with other planets of solar system, you can see it's not that big, isn't it? Now, the biggest planet, Jupiter, when we see it looks quite big, right? When you compare it in terms of the size of the Earth. But again, if you go ahead and if you compare with the size of Sun, again it seems quite small. Our Sun is so big. And then when you compare the size of the Sun to some other stars that we have in our universe, you'll feel, well, Sun is not that big. And to some of the biggest of the stars, if you compare, it goes ahead and you will find that there are always bigger stars in our universe, and our universe itself will find much more bigger, galaxies into it. So ratio becomes very important to compare, to know where you stand and where you should go ahead. Generally we say that comparison should not be done. It makes you feel sad when you see someone, going over you. But that gives you an opportunity, right? When you compare, that if you want to go ahead in your life, if you want to perform better in your life, comparison is important, right? So let us get into ratios. Now, how do we express ratios? Which is the correct form of expressing ratios? This one is one, or this one, or this one. See, basically, if you look at these figures, these expressions, there is a percentage sign here, there is some upon sign here, and there is to sign here. It means that all these three are expressions or the way of expressing ratios. How? When you say it is percentage, you are comparing with something which we can say 100. If some other thing is 100, then this amount is 25. Similarly, this is one of the four parts. So again, there is a comparison of two things. Similarly, there is a sign of is to, which means if one element is 1, then the other element is 4. So basically, all three mean the same. It is 25% or one part of the fourth part. 4 different parts. Out of that 4 parts, your one item is the one part of that 4, that is 25%. So all three mean the same and all three are the ratios, right? Now, let us start with our understanding regarding ratio analysis. It is a method or process by which the relationship of items or group of items in the financial statements are computed and presented. It is an important tool of financial analysis. It is used to interpret the financial statements so that the strengths and weaknesses of a firm, its historical performance and current financial conditions can be determined. Now let me just explain you this theory in terms of an example. Suppose there are two businesses. One business is earning a profit of 5 lakh rupees and another business is earning a profit of 10 lakh rupees. If you just relate in terms of amount, you will say, okay, the business which is earning profit of 10 lakhs is doing a better business, right? But if I say the business that is, earning a profit of 5 lakh is making a sales of say 10 lakhs and still it is earning a profit of 5 lakhs. Whereas the business which is earning a profit of 10 lakhs is making a sales of 50 lakhs. Now ratio comes into picture. That the first business is able to earn half of the sales, means 50% is the profit ratio it has, whereas the other business is earning 10 lakhs for the turnover of 50 lakhs. So it has only 20% return. So you can compare, when you have ratios in your hand, the return percentages will determine who is performing better, right? So this way ratio becomes very important. A mathematical yardstick that measures the relationship between two figures or group of figures which are related to each other and are mutually interdependent. So this is the meaning of ratio. It can be expressed as a pure ratio, percentage, or as a rate. The previous slide we saw that it can be expressed in any of the ways which were mentioned on the slide. So here you need to have some caution while using ratio. A ratio is not an end in itself. They are only means to get you to know the financial position of an enterprise. You need some skills to understand the ratios. You need to apply your understanding regarding the ratio. It will not suggest which is good and which is bad. You need to understand accounting first and then you can apply ratio analysis. Computing ratios does not add any information to the available figures. You're just putting in the amounts in terms of figures, but how to use those percentages or ratios is very important. It only reveals the relationship in a more meaningful way so as to enable us to draw conclusions therefrom, right? Now, utility of ratio, how useful ratios become or how we can use it. Accounting ratios are very useful in assessing the financial position and profitability of an enterprise. However, its utility lies in the comparison of ratios. So basically, once you get the ratios, then comparison starts. Just like in any of the year in your schooling, whenever you used to get your result, your parents used to ask you how much percentage the student, your friend got. So then they can compare who is studying properly. You are at the same level and same percentage itself shows the ratio and then comparison is done. This is done right from the beginning. So utility, comparison may be in any one of the following forms. Now how you can compare? For the same enterprise over a number of years, your performance is assessed in comparison with your current year's performance with the previous year performance. For example, when you are in school, your every year's percentage result was compared with your previous year's result, whether you have improved or you have deteriorated your percentage. That way comparison is possible with the help of ratio analysis. Similarly, For two enterprises in the same industry, when your result and your friend's result are compared, it is the utility of ratio, right? For one enterprise against the industry as a whole, right? So your result is compared with the overall result. If you are a student of VNSG, you always tend to compare your result, what you got, and what is the overall average result of the university. Thereby you can, make sure that how well you have studied as compared to the average student of the university. This way ratio is very helpful. For one enterprise against a predetermined standard, right? There are certain standards. For example, when you study, it is expected that first class should be the minimum that you should get, so that you can be considered as a good student. This is the industry norm. You can say that first class shows that a student is a first class student or a good student. So thereby you can compare your performance with that standard. And for inter-segment comparison within the same organization, you can compare, for example, your result with your internal marks or your subjects, what you scored in the last semester or last year. Thereby comparison is possible. Now, I've given you the example in terms of your understanding regarding ratios, that is the percentage that you use in your day-to-day life. For the same things apply for the businesses as well. They compare their performance with the help of ratios in this manner, right? So ratio analysis is done to know the various aspects of the business. Every business has its own way of doing the things, but how well the business is performing is its activities can be known by these aspects, financial aspects of the business, right? So for example, if you are earning a good income, then your income is compared in terms of how well you are living your life, what kind of clothes you are wearing, what kind of health you have. So your performance is not just measured in terms of how much amount of money you earn, but all these aspects that makes your life better. Similarly, for a business, how well you are managing the finance is something that every business should focus on. So first is, it talks about the financial aspects. All the financial aspects are analyzed in ratio analysis. Then your liquidity, how well you are able to manage the liquidity part, how well you are able to pay out your short-term debts with the help of your short-term assets. Similarly, investment, how well you are able to invest the money to give proper return to the shareholders. How well your business is geared, how you are managing your funds. Is it debt funds or is it own funds that you are doing the business with? And it shows how well you are managing your profitability, how profitable your business is. So it shows so many aspects. It analyzes so many aspects of the business. So liquidity is the ability of the firm to pay its way, whatever short-term debts are there, how well you are able to pay them on time. Investment or share or information to enable decisions to be made on the extent of the risk and earning potential of a business investment. Gearing, information on the relationship between the exposure of the business to loans as opposed to share capital. Profitability, how effective the firm is at generating profits given sales or its capital assets, how well you are able to earn profit out of the sales or whatever investments you have put into the business, how well you are managing the returns out of it. Financial is the rate at which the company sells its stock and efficiency with which it uses its assets. So all these aspects can be focused, can be highlighted, can be worked out upon, can be improved with the help of ratio analysis. Now let us talk about classification of ratios. Now generally ratios are in a simple terms or traditional way of classification of ratios. The ratios are classified into three broad categories. When you use two items from the income statement, that is profit and loss account, both the items belong to it, then it becomes a P&L ratio. If you use two items out of balance sheet and then try to find the relationship between the two items, it becomes a balance sheet ratio. And the third is when you use one item of P&L account and one item from balance sheet and then try to find the relationship between these two items, it becomes a composite ratio. This is a traditional classification of ratio, but here we are focusing on more objective oriented classification. What you want to know out of that ratio. So if you categorize objectively these ratios, then ratios can be classified as liquidity ratio, capital structure or leverage ratio, right? Profitability ratio and activity ratios. So these are the broad four categories on which you can distribute all the ratios that will give you an idea about the overall efficiency of your business, right? So first we talk about liquidity ratio. These ratios analyze the short-term financial position of a firm and indicate the ability of the firm to meet its short-term commitments, that is the current liabilities, out of its short-term resources, that is the current assets. These are also known as solvency ratio, and the ratios that indicate the liquidity. Which ratios we include in the liquidity ratio? That is current ratio and liquidity ratio, or you can call it quick ratio or acid test ratio. So these are the broad category of ratios that you calculate under the type of ratios, that is liquidity ratios. So I'll talk about the current ratio. So it is calculated by dividing current assets by current liabilities, a very simple formula to remember. So when you divide your current assets by current liabilities, where conventionally a current ratio of 2:1 is considered satisfactory. Now what does this ratio mean? It means that if you get an answer of 2:1, it shows that when you have to pay 1 rupee of liability, you have 2 rupees worth assets with you. So you can easily make the payment to your liabilities. So ideally, this ratio should be 2:1. So that for every 1 rupee of payment of current liability, you have 2 rupees of current assets. So current assets include all these items. You can pause the video and check what are the things that are included in current assets. For current liabilities, these are the items. You can just have a look at it. Quick ratios. There is a ratio. This is a ratio between quick current assets and current liabilities. Alternatively, you call it quick liabilities. It is calculated by dividing quick current assets by current liabilities, or you can say quick current liabilities. So basically, the formula of this ratio is quick assets upon current liabilities, or you can even call it quick liabilities. So conventionally, a quick ratio of 1:1 is considered satisfactory. Liquid ratio, we can call this in a simple terms. So it shows that for every 1 rupee of liquid liability, you need to have 1 rupee of liquid asset, so that you can easily make the payment as and when emergency of payment arises. So 1:1 is ideal ratio for this. So what is the difference between current assets and current liabilities and quick asset or liquid asset and liquid liabilities? When you have current assets, you have to just deduct prepaid expenses and stock related items, that is inventories. So you will get the liquid asset, or you can say quick asset. And for liquid liabilities, you need to deduct bank overdraft and income received in advance, so that you know exact liability amount, the liabilities which you will be required to pay at urgency. That is the quick liability or liquid liability. Capital structure or leverage ratios. These ratios indicate the long-term solvency of a firm and indicate the ability of the firm to meet its long-term commitment with respect to repayment of principal on the maturity or in the predetermined installment at due dates, and periodic payment of interest during the period of loan. Right. So basically, this ratio will show how well you are managing your long-term liabilities. Right. Capital structure, how what's the ability of the firm to meet the long-term commitment, long-term obligations. So these are the ratios that you calculate under this category: debt equity ratio, proprietary ratio, debt to total capital ratio, interest coverage ratio, and debt service coverage ratio. Let us first talk about debt equity ratio. This ratio indicates the relative proportion of debt and equity in financing the assets of the firm. It is calculated by dividing long-term debt by shareholders' funds. So debt equity is long-term debts upon shareholders' funds, where generally financial institutions favor a ratio of 2:1. Right. So that is for every 1 rupee of shareholders' fund, you need to have 2 rupees of long-term debts. That will ensure your the kind of decision making power or the voting power, that you want to have a limited voting power, or involvement into the business of shareholder, you want to reduce that. So you need to maintain certain level of ratio, that is 2:1. So debt equity is long term debts upon shareholders funds. However, this standard should be applied having regard to the size and the type and the nature of business and the degree of risk involved. So again, this is not ideal for all the business. It all depends and it all varies from business to business. So long-term funds here mean long-term loans, whether secured or unsecured, like debentures, bonds, loans from financial institutions. And shareholders funds include equity share capital plus preference share capital plus reserves and surplus minus any fictitious assets, or you can say accumulated losses like preliminary expenses, past accumulated losses, discount on issue of shares, etc. Then we talk about proprietary ratio. So this ratio indicates the general financial strength of the firm and the long-term solvency of the business. This ratio is calculated by dividing proprietors funds by total funds, that is proprietary ratio is equal to proprietors funds upon total funds or assets. So whatever your proprietor funds is as compared to the total funds of the business, you try to find the relationship between the two. So as a rough guide, a 65 to 75% proprietary ratio is advisable. Proprietary funds are the same as explained in the shareholders fund. It is everything the same. See here, shareholders funds and proprietary funds are one and the same. Total funds are all the fixed assets and all the current assets. Alternatively, it can be calculated as proprietors funds plus long-term funds plus current liabilities. So this way you get total funds. Debt to total capital ratio. So in this ratio, the outside liabilities are related to the total capitalization of the firm. It indicates what proportion of the permanent capital of the firm is in the form of long-term debt. So debt to total capital ratio is equal to long-term debt upon shareholders funds plus long-term debt. So total of shareholders funds plus long-term debt, and you tend to compare it with the long-term debts. So conventional ratio of 2:3 or 2/3 is considered as satisfactory. Interest coverage ratio. So this ratio measures the debt servicing capacity of the firm. As the name suggests, how well you are able to cover the interest out of your profit. Certain interest that you need to pay every time, every year, that is interest on debenture, interest on long-term loans. How well you are able to manage that. So this ratio measures the debt servicing capacity of a firm in so far as the fixed interest on long-term loan is concerned. It shows how many times the interest charges are covered by EBIT, out of which they will be paid. Interest coverage ratio is equal to EBIT upon interest. A ratio of 6 to 7 times is considered satisfactory. Higher the ratio, greater the ability of the firm to pay interest out of its profits. But too high a ratio may imply lesser use of debt and very efficient operations. So this way. Next is total coverage. Now, it's not just the interest that the company need to get out of the profit. It has to get all the other payments, regular payments it has to make. So total coverage ratio this is a more comprehensive measure to compute the debt servicing capacity of the firm. It shows how many times the total debt service obligation consisting of interest and repayment of principal in installment. So it's not just interest that you need to cover out of the profit. It's the repayment of the original, the principal amount that you have to pay at a certain point of time. That should be also taken into consideration. So that is why it is said total coverage, how well you are able to cover your debts. So here it is saying it shows how many times the total debt service obligation consisting of interest and repayment of principal in the installments are covered by the total operating funds after repayment of tax. So total coverage ratio is equal to EBIT. So here you had only interest, earnings before interest and tax. You have to compare that how many times more your profit is as compared to interest. Now here you are not just taking only interest into consideration, but all the payments that you have to make out of the profit. So interest plus dividend plus installments, right? So it is Earnings after tax is earning after tax. So interest, dividend and installment, how many times you are able to cover with your current profit. It is what this ratio explains. Generally, financial institutions consider 2:1 as a satisfactory ratio. So means you should have 2 times the profit of the total of all these things: interest, dividend plus installment of loan. Profitability ratios, this is another category of ratios. So these ratios measure the operating efficiency of the firm and its ability to ensure adequate returns to its shareholders. The profitability of a firm can be measured by its profitability ratios. Further, the profitability ratios can be determined in relation to sales or and in the relation of investments. So you need to compare your profits with whatever sales you are making so that you know your operations, how well you are managing the operations. And if you compare it with the investments that you have made in the business, you can know how well you are actually managing the business. If you are not getting proper returns on that business, then there is no point of continuing with that business. You can put your funds in some other, more profitable ventures. So for profitability ratios comparing to the sales, we have gross profit ratio, net profit ratio, or expense ratio. So profitability ratios are in relation to investments, return on investment, how much return you get on the assets, return on asset, then return on capital employed, that is ROCE. All the funds that you put into the business is capital employed. Return on shareholders equity, only considering the equity shareholders funds, that is shareholders equity. Earning per share, dividend payout ratio, how much dividend is declared out of the profit, that is dividend payout ratio. And price earning ratio, as compared to price, how well the earnings are made by the shareholder. So that is price earning. So let's talk about gross profit ratio. So this ratio is calculated by dividing gross profit by sales. It is expressed as a percentage. Gross profit is the result of relationship between prices, sales volume and costs. So gross profit margin or gross profit ratio is gross profit upon net sales into 100. Sorry for the change in the formatting because of the PC change in the PC. There is always going to be some formatting that changes. So anyways, the formula is gross profit margin is equal to gross profit ratio upon net sales into 100. So a firm should have a reasonable gross profit margin to ensure coverage of its operating expenses and ensure adequate return to the owners of the business, that is the shareholders. To judge whether the ratio is satisfactory or not, it should be compared with the firm's past ratios or with the ratio of similar firms in the same industry or with the industry average. So it's up to you how you want to use the ratio that you calculate. You can use it for comparison, and there are various ways of comparing ratios. Net profit ratios, this ratio is calculated by dividing the net profit by sales. It is expressed as a percentage. This ratio is indicative of the firm's ability to leave a margin of reasonable compensation to the owners for providing capital after meeting the cost of production, operating charges and cost of borrowed funds. So net profit ratio is net profit after interest and tax upon net sales into 100. That 100 will come here. So net profit ratio is another variant of net profit margin is operating profit margin, which is calculated as net profit before interest and tax into 100. Net profit before interest and tax upon net sales into 100. So generally, so far as the VNSU is concerned, whenever they ask you net profit ratio, you have to use formula which we have seen in the previous slide. It is always after interest and tax that we consider net profit. This can be used additionally if they ask you, you have to calculate net profit before interest and tax, then you only use this formula. If they just say net profit ratio, then it is always after interest and tax that you need to calculate in exam. Higher the ratio, greater is the capacity of the firm to withstand the adverse economic condition and vice versa. Expense ratio is very simple. I am not going into the depth. Any expense divided by net sales into 100 will get you the answer of that expense ratio. It's very simple. So I'm not going into the depth. It's a very simple understanding that you want to know how much percentage of sales is that particular expense, so that you can focus, you can target. If you want to reduce that expense, you can do that once you have this ratio. Return on asset is, this ratio measures the profitability of the total funds of a firm. It measures the relationship between net profits and total assets. The objective is to find out how efficiently the total sales have been used by the management. So net profit after taxes plus interest upon total assets into 100. Now be very careful when you using any of the profitability ratio. When which net profit comes, you need to focus very carefully to avoid mistakes in exam. Here you use net profit after taxes plus interest upon total assets into 100. So total assets exclude fictitious asset, as the total assets at the beginning of the year and at the end of the year may not be the same. Average total assets may be used as the denominator. Return on capital employed, ROC, one of the very important ratios that asked in exam. So you have to do it very nicely and remember how the things are calculated when you do return on capital employed. This ratio measures the relationship between net profit and the capital employed. It indicates how efficiently the long-term funds of owners and the creditors are being used. So basically it involves both funds of the owner and funds from outside. Total becomes your capital employed. So return on capital employed is, here see net profit again changes. Here you use net profit before interest and tax upon capital employed into 100. So capital employed denotes the shareholders' funds and long-term borrowings. To have a fair representation of capital employed, average capital employed may be used as the denominator. Return on equity shareholders' funds, or you can even call it return on shareholders' equity. So this ratio measures the relationship of profits to owners' funds. Shareholders fall into two groups, that is preference shareholders and equity shareholders. So the variants of return on shareholders' equity are return on total shareholders' equity, net profit after tax minus preference dividend upon equity shareholders plus free reserves minus fictitious loss into 100. So this will be return on equity shareholders' funds. Now when they say return on shareholders' funds, then you include both equity and preference. But when they say return on equity shareholders' funds, then take only equity. You don't have to include preference into it. But when they just say shareholders' equity, or sorry, total shareholders, then you have to take preference as well as the equity. So this is what we have already discussed, return on equity shareholders' funds. Earnings per share. This ratio measures the profit available to the equity shareholders on a per share basis. So this ratio is calculated by dividing net profit available to equity shareholders by the number of equity shares. So once you get net profit, you deduct tax, you deduct interest and then tax, and then deduct preference dividend as well. So whatever is now left belongs to equity shareholders. So when you divide the number of shares, the net profit that is left divided by the number of shares you have issued, number of equity shares, then it will get you the answer of earnings per share. Dividend per share is, this ratio shows the dividend paid to the shareholder on the per share basis. This is a better indicator than the EPS, as it shows the amount of dividend received by the ordinary shareholders. While EPS merely shows the theoretically how much belongs to the ordinary shareholder, it actually shows how much dividend per share the shareholder have received. So the formula here is dividend paid to the ordinary shareholders divided by number of equity shares. So it will show a better realistic view of what actually the shareholders are getting, that is called dividend per share. Dividend payout ratio. So basically whatever profit was available, out of that how much you are given as dividend, that is the dividend payout ratio. So this ratio measures the relationship between the earning belonging to the ordinary shareholder and the dividend paid to them. So dividend payout ratio is equal to total dividend paid to ordinary shareholders, net profit upon net profit after tax minus preference dividend multiplied by 100. So you can even find dividend payout ratio by this formula, that is dividend that you are given per share upon earnings which were earned per share multiplied by 100. So you will get the answer of dividend payout ratio. Price earning ratio. This ratio is computed by dividing the market price of the shares by the earnings per share. It measures the expectations of the investors and the market appraisal of the performance of the firm. So price earning ratio is equal to market price per share upon earnings per share. So how or what earnings you are making for the market price against the market price, that is the price earning ratio, comparison of the share market price and the earnings that is made on that share. Now we go to the next category, that is activity ratios. So these ratios are also called efficiency ratio or asset utilization ratios or turnover ratios. These ratios show the relationship between sales and various assets of a firm. So the various ratios under this group are inventory or stock turnover ratio, how many times during the year your stock changes, so that is stock turnover. Debtors turnover ratio and average collection period, in how many days the debtors make the payment to you, right? That is debtors turnover, you can say collection period. Asset turnover ratio, how many times you are changing the assets. And creditors turnover ratio, or you can say average credit period, in how many days you are paying to the creditors, that is creditors ratio, or you can say average credit period. Inventory or stock turnover ratio, this ratio indicates the number of times inventory is replaced during the year. It measures the relationship between cost of goods sold and the inventory level. There are two approaches for calculating this ratio. Inventory turnover ratio is equal to cost of goods sold upon average stock, wherein you can find out average stock by getting a simple formula, opening stock plus closing stock divided by 2. So use this average stock into this formula, cost of goods sold upon average stock, you will get the answer of stock turnover ratio. Very important from the point of view of examination. A firm should have neither too high nor too low inventory turnover ratio. Too high a ratio may indicate a very low level of inventory and a danger of being out of stock and incurring a high stock out cost. Means you don't have inventory and there is a stoppage in the production process, that is going to affect your overall expenses. So you don't want that to happen. Plus on the contrary, too low ratio indicative of excessive inventory entailing excessive carrying cost. If there is a very low ratio, that means you are not able to change the stock 2 times, 3 times, it's so less stock turnover ratio that it means that you are putting so much of stock in your godown and you are adding to your carrying costs. Debtor turnover ratio you can also call average collection period. So this ratio is a test of liquidity of the debtors of a firm. It shows the relationship between credit sales and debtors. So debtors turnover ratio is credit sales upon average debtors and bills receivable. And average collection period is month upon days in a year upon debtors turnover ratio. If you don't want to use two formulas and you are just asked average collection period, just reverse this formula, average debtors and bills receivable upon credit sales into number of days in a year, you get the answer of average collection period. This also can be done. So debtors ratio and average collection period, these ratios are indicative of the efficiency of the trade credit management. A high turnover ratio and a shorter collection period indicate prompt payment by the debtor. On the contrary, low turnover ratio and longer collection period indicates delayed payments by the debtor. In general, a high debtor turnover ratio and a short collection period is preferable. So they are regularly paying you the money whenever you sell the goods on credit to them. That is what debtors turnover ratio indicates. So you need to focus on trying to get a higher turnover and lower collection period. Asset turnover ratio, depending on the different concepts of assets employed, there are many variations to this ratio. These ratios measure the efficiency of a firm in managing and utilizing its assets. Total asset turnover ratio is equal to sales upon cost of goods sold upon average total assets. Fixed asset turnover is sales or cost of goods sold upon average fixed asset. Capital turnover ratio is sales or cost of goods sold upon average capital employed. And working capital turnover ratio is sales or cost of goods sold upon net working capital. So this way you can calculate asset turnover. So higher ratios are indicative of efficient management and utilization of resources, while low ratios are indicative of underutilization of resources and are and there is a presence of idle capacity. Creditors turnover, it's the exact opposite of debtors turnover. In debtors, you have to calculate how well you are getting the money, and here it indicates how well you are paying the money. Right? Instead of sales, you will use the word purchase. Instead of debtors, creditors. Instead of bills receivable, you use the word bills payable. So almost the working remains the same. So this ratio indicates shorter credit period signifies the creditor are being paid promptly, and it enhances the creditworthiness of the firm. That you should target, that you will pay creditors on time so that you can get more credit in the future by increasing the creditworthiness. So that's it for this video. I hope you have understood the overall concept of ratio analysis. If we get time in future, we'll definitely solve few sums for university exam preparation. Right? If you like this video, please hit the like button. If you have not subscribed this channel, please subscribe it, and don't forget to share this kind of videos with your friends so that they also get the opportunity to learn through this channel. So that's it for this video. Thank you so much.